I've said many times that if you get to be 65 or 70,
What if I told you that one of the greatest financial advantages on earth isn't hidden in secret algorithms, insider tips, or risky crypto bets, but in a set of rules so simple that most people ignore them? Warren Buffett didn't build his fortune by predicting the next big thing. He didn't trade every day. He didn't panic when markets crashed. Yet year after year, decade after decade, he quietly outperformed almost everyone. Here's the real shocker. You don't need billions, connections, or genius-level math skills to apply his strategy. You can start with a small amount. You can start today. In this video, you're going to learn 6 timeless investment rules inspired by Warren Buffett's journey. Rules that work in bull markets, bear markets, recessions, and recoveries.
to see where the stocks are going.
But don't skip ahead, because before we break down the rules, you must understand the mindset that made them work. If you care about building long-term wealth instead of gambling for quick wins, stay with me until the end and take action today. Buffett's core money. Mindset: wealth begins before money. Warren Buffett often says something that sounds almost too simple. The most important investment you can make is in yourself. Long before he became one of the richest people alive, Buffett invested in knowledge. As a child, he spent hours reading books about money, business, and numbers. As a teenager, he analyzed companies for fun. As a young adult, he studied under legendary investor Benjamin Graham, learning the foundation of value investing. His first stock purchase happened when he was just 11 years old. It wasn't perfect, but it taught him patience. While most people chase fast money, Buffett focused on long-term consistency. By age 30, he had turned a modest amount of capital into over $100,000. Not through luck, but through discipline and risk control. Market crashes came, recessions followed, bubbles burst. Buffett survived them all because his foundation was built on understanding, not hype. Even today, he spends the majority of his time reading, not because he has to, but because learning compounds just like money does. Lesson: money follows knowledge. Always. Now let's break down the 6 rules that turned this mindset into massive wealth. Rule number 1, invest only in what you understand. One of Buffett's most famous principles is also one of the most ignored. If you can't explain how a business makes money in simple terms, don't invest in it. Buffett avoids complex companies, trendy buzzwords, and businesses that require advanced assumptions to justify profits. Instead, he looks for clear products or services, simple business models, predictable demand, strong customer loyalty. This is why he avoided many tech companies for years, not because technology is bad, but because he didn't fully understand their long-term economics. When he eventually invested in Apple, it wasn't because of flashy gadgets. He saw Apple as a consumer brand with a powerful ecosystem, one that keeps customers coming back year after year. Key takeaway: if you don't understand the business, you can't predict its future. And if you can't predict its future, you're not investing, you're guessing. Rule number 2, look for a strong economic moat. Buffett often talks about something called an economic moat. Imagine a castle surrounded by a deep river. The wider and deeper the river, the harder it is for enemies to attack. In business, a moat is what protects a company from competitors. Examples include powerful brands, unique products, massive distribution networks, loyal customers, cost advantages. Coca-Cola's moat is its global brand and distribution system. Apple's moat is its ecosystem and customer loyalty. Costco's moat is its pricing power and membership model. Buffett doesn't look for companies that might win next year. He looks for companies that can keep winning for decades. That's why he bought Coca-Cola shares in the late 1980s and never let go. Over time, dividends alone returned many times the original investment. Lesson: a strong moat means long-term profits, reduced competition, and stability when markets get rough. Rule number 3, buy quality at a fair price. Buffett is often misunderstood as someone who only buys cheap stocks. That's not true. He looks for great businesses and waits patiently until their prices make sense. As he famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This patience is rare. During market crashes, fear drives prices far below real value. That's when Buffett pays attention. While others panic, he analyzes. While others sell, he waits. His investments during major financial downturns didn't happen by accident. They happened because he prepared in advance. Price matters, but quality matters more. Over time, great businesses reward patient investors. Rule number 4, think long-term and let compounding do the work. One of Buffett's biggest advantages isn't intelligence, it's time. He rarely sells good businesses. Instead, he lets them grow year after year while reinvesting profits. This creates the most powerful force in finance, compound growth. Small gains become big gains. Big gains become massive gains. Most people underestimate what compounding can do over decades. Buffett's success proves that time in the market beats timing the market. The real secret isn't speed, it's consistency. Rule number 5, stay calm when others panic. Markets move on emotion. Fear pushes prices down. Greed pushes prices up. Buffett's advantage is emotional discipline. He follows a simple rule: greater than be cautious when others are excited and brave when others are afraid. During crashes, many investors sell at the worst possible moment. Buffett sees crashes as opportunities, not disasters. The key is preparation. He keeps cash available so he can act when others can't. Lesson: emotional control is a financial superpower. Rule number 6, keep costs and taxes low. One of the most overlooked wealth killers is fees. High trading costs, management fees, and taxes quietly drain returns over time. Buffett keeps things simple: minimal trading, long holding periods, cost-efficient strategies. For everyday investors, this often means low-cost funds, tax-efficient accounts, avoiding unnecessary trades. Saving even a small percentage in fees can result in massive gains over decades. What you keep matters more than what you earn. Putting Buffett's strategy into action. Let's simplify everything. 1. Learn before you invest. 2. Stick to businesses you understand. 3. Look for durable advantages. 4. Be patient with pricing. 5. Reinvest and let time work. 6. Stay calm and keep costs low. You don't need to copy Buffett's exact investments. You need to copy his principles. Whether you start small or large, the rules remain the same. Warren Buffett didn't win by moving fast. He won by never stopping. While others chased shortcuts, he followed principles. While others panicked, he stayed patient. And that's why his results look almost impossible. If this video helped you see investing differently, don't just watch, act. Start learning, start small, start today. Because your future wealth isn't built in a single decision, it's built in thousands of disciplined ones. Subscribe for more deep financial breakdowns, and remember, slow, steady, and smart always beats fast and flashy.